Minutes to the Federal Reserve's May meeting show that Fed officials agreed the next move after that May rate hike was less certain due to uncertainty about the impact of the lagged effects of tightening and tighter bank credit policies that could be coming. Many Fed officials said the Fed needed to, quote, retain optionality after that May hike. Some saw a need for additional rate hikes due to slow inflation. The inflation progress coming down had slowed. And several said that if the economy evolved the way they thought, they did not see a need for further rate hikes. But some wanted to stress in that meeting it was important for the Fed to communicate that rate cuts were not likely this year and that they were not ruling out further hikes. So they wanted to retain that optionality. That runs throughout. They also said, they stressed it was important to raise the debt limit to avoid risks to the economy and financial systems. There were several comments on the debt limit. I'll get to those in a second. On the economy, the Fed should be ready to, on the debt limit and banking system, the Fed should use its liquidity tools to mitigate future financial stability risk. Could have been talking about the banks there. Could have been talking about the debt ceiling. Unclear. Tighter credit conditions, though, from the banks were seen weighing on economic activity, households and firms, and hiring and inflation. But they stressed it was too early to say what kind of effects they would have. Some saw only modest effects. Fed rate hikes had contributed to restrictive financial conditions. They saw slower GDP, a labor market softening, and a need to reduce inflation. At the time they met, it was interesting. They talked about banking conditions actually having improved from the worst days of the Silicon Valley Bank failure. Consumer spending was strong in the first quarter. However, it was expected to slow. The labor market was seen very tight. Some saw signs of easing of labor market conditions. For example, they noted less difficulty in hiring. Wage growth, however, was still too high, and inflation was said to be, quote, unacceptably high. And again, they repeated this idea that inflation was more slowly than they had expected. And again, on debt default, there was concern about it expressed at the meeting. It threatened a significant disruption to the financial system and the economy. Also, commercial real estate was listed as a risk to the banks. One final comment, the staff continued to forecast a mild recession in the fourth quarter of this year and the first quarter of next due to tighter credit conditions from the banks. Guys?
Very interesting, Stephen, and I'm going to ask you to stick around as we get a little further reaction there. There's a lot to unpack